My name is Amy Meissner, and I've been a part of the community of traders that Tom was involved in for many years, I think since 2005 or 2006.
Yeah, 2006 for me.
2006. So basically, just a little bit about me, for those of you who don't know me. I dabbled in options trading starting in the mid-90s. I did it for a short while, just kind of read an article about it. It was kind of new. At the time, you had to have a special, sign up with a special brokerage firm, or for, there's more than one, but not too many in Chicago, in order to trade options at the time. And the liquidity wasn't really quite there, and the commissions were very high at the time. But it was an interesting little lesson, and unfortunately, it wasn't, very profitable for me. It was kind of like a break-even situation, so I kind of gave it up. And took about 10 years before I decided to learn a little bit more about options trading and got involved in learning more about it in late 2005. And with the proper training, I actually ended up doing very well and started trading full-time in 2006 and have been doing it since. So I learned a variety of different strategies, all more on the high probability income type trading of options. My favorites, I tried all sorts of different strategies, but my favorites quickly became the double diagonal and the iron condor. Those suit my lifestyle, which is basically I don't want to be sitting in front of my computer all day. I like to be able to be out and about and doing things, and but still manage my risk as well. And then, of course, as time went on and the market conditions changed over the years, and different years bring different things, I've constantly kind of tweaked the way I trade, and of course, with learning and so forth, and came up with a trade that I had become basically my bread and butter trade, which was the nested iron condor, which I spoke about a little bit on Capital Discussions. I don't know, about a month ago, something like that, maybe 2 months ago, and I was planning on doing it. I don't know if they'll have me back. I'll do a more detailed version of that in the future, hopefully. But one of the trades that I've also been working on that I've learned about a couple years ago and kind of, doing kind of my version of it is what's been dubbed the Weirdor trade. I know that it goes by many different names, and it's been really profitable and a nice trade for me that I've been doing for a little over a year now, for about a year and a half, but definitely as my main trade. I've kind of taken this on as more of my main trade as opposed to the nested condor just over the last year, because I really wanted to experiment with it and use most of my margin towards it. But I still do like the nested condor as well. It's also a nice trade. This one takes a little bit more trading, but it still suits my lifestyle. So that's what I'm going to talk about today.
Amy, before you get started, somebody said the sound's not very clear, and maybe slow down a little, or maybe the microphone thing. I don't know.
Okay. I will try to slow down a little bit. I appreciate the input before I really
not even from New York.
Hey, Jim.
Hey, Jim.
I'm sorry, Amy. I was signed in as Tom before. That's why Tom didn't realize. Tom, I upgraded my PC and I got my old password. Sorry about that. And I said, they asked you to slow down, and you're not even from New York.
I know. What's going on? I think traders tend to speak fast, I noticed. So maybe I'm, over the years, I'm starting to, I always thought that I talked slow, but maybe it's finally catching up with me. I apologize. So I will try to slow down and be more, easier to listen to for presentation purposes. So, but anyway, I'm going to get started talking about the Weirdor trade, which goes by many different names. But before I get started, I'll just basically the same disclaimer as Tom's presentation is for educational purposes only. I'm not a broker-dealer or investment advisor. I don't know your situation. I have no way of knowing what risk is appropriate for you, and I'm not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trade. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. Past performance is not indicative of future results, and so on and so forth. So you guys can read that. Get that out of the way. And so basically, the Weirdor is kind of like a variant of the Condor trade. It's more of like an asymmetrical Condor, so to speak. So some of the characteristics of this particular trade is that it's relatively smooth, as opposed to, for instance, you know, as you're going along in time and doing these every month, or I like to do them every month, you tend to have less drawdowns than you would in an iron Condor situation. Of course, you're not really taking any losses until you exit the trade, but you have more of a smooth T+0 line. You're not making any big jumps to the downside as the market moves, as you would in some other trades. So it tends to be a little bit smoother ride as you're going along, and the adjustments are relatively easy. However, there are more adjustments to make than in my nested Condor, but it's very manageable. So it's also a high probability trade. There's a high probability of wins, about 85% or higher. And overall, what I've noticed, and it's not necessarily in all markets, but in most markets, the Weirdor tends to have an overall higher expected return than a conventional Condor. I'd say the nested Condor sometimes outdoes it, but they're very even. It's definitely has a lower sensitivity to volatility than a conventional Condor. You won't be you won't move as much. You have a much lower vega, not much lower, but you do have quite a bit lower vega in the Weirdor than you do in the Condor, which I will show as I get to examples. There's minimal upside risk. As a matter of fact, that's where the asymmetric comes into place, where there's not as much risk that you're putting on the upside, which sounds kind of counterintuitive because everybody's usually worried about the downside moves, but because of the type of protection that you can put on the downside and the premium that you're able to get on the put side as opposed to the call side, it makes it more of a balanced trade, having less calls as opposed to doing a reverse Weirdor where you would have less puts. But basically, there's minimal upside risk because I'm not really defending the calls as much, and I'm not putting on as much risk on that part. And the downside risk is generally easy to manage using additional debit spreads, which can be put in additional contingent orders and so forth. So, and I will go over all of that. So let's continue. So basically, there's four main parts of a Weirdor. There's the put credit spread, which is where the bulk of the profit and the money that you're looking for, the profit to make, is coming from. So that's the main piece that you want to make, I want to get correct when I'm putting one of these on. Is I want to make sure I'm picking the right credit spread that's going to keep me, not too risky and getting a nice chunk of money, hopefully, at the end of the trade. The put debit spread, which is the second part of the Weirdor, is in place to balance it out and to give protection on a down move, so that I'm not just losing money on my credit spread, but I'm actually able to take some of that hit with the debit spread in front of it. The call credit spread is the third part of the Weirdor, which is put in place to, again, balance out the trade, make the T+0 line flatter, and to bring in a little bit of extra premium, even though I'm not really going to defend it very much. And then what I like to do as well, as you'll see in some other people's versions of the Weirdor, is I like to put in on additional far out of the money puts. Sometimes sometimes they're at the long of the put credit spread, sometimes a little bit further. And that, again, kind of flattens out the T+0 line so that you have a relatively smooth trading as opposed to a lot of big moves as you're trading this as time goes on. And so with that, I'll just go through the general guidelines. And now these guidelines that I've created here are just the general guidelines for the Russell 2000, which is what I prefer to trade. However, you can use other indexes can be used, so like the SPX or the NDX. Also, some stocks that have higher values can be used as well. I wouldn't recommend the IWM or the SPY as far as doing the whole Weirdor, only because it works just the same, but because of the ratio of credit spreads to debit spreads and so forth, probably unless you're not having to pay any commissions at all, the trade will get eaten up by commissions quite a bit because you're just not bringing in as much premium for the amount of contract that you have to do. So I tend to stick with the indexes, but it can also be used with higher valued stocks as well. I like to get in anywhere between 40 to 55 days to expiration. I know it's kind of a big window, but I can start looking around 55 days and pick my spot, and I know that I'm okay even at 40 days. But 45 days is usually, I'd like to get in by then, prefer to get in by then as opposed to take it all the way down to 40. In the Russell 2000, I do 20-point spreads on all of my credit spreads and debit spreads. And for the put credit spread, the short side of that should be at least 7% out of the money and less than a 16 delta. And again, I'll go through examples shortly and kind of tell you how I figure out where I'm going to be for that particular expiration cycle. But that's like a basic guideline. I don't want to be any closer than 7% out of the money, and I don't want to have a delta of higher than 16 on my short put for the credit spread. The lower the delta and the higher the percentage out of the money, the better, obviously, for risk purposes. But of course, I have to make a certain amount of bring in a certain amount of premium to make the trade worth it as well. So there's kind of a balance there. The put debit spread that I put on is in front of the put credit spread quite a bit. It's actually around 10 to 15 points out of the money from wherever the index is at that particular moment in time. So anywhere from 10 to 15 points. The call credit spread, the short should be around a 12 delta or less and at least 5% out of the money. And I'm not, like I said before, I'm not really going to defend those very much. And as I'm sure a lot of you have been trading for a while, and I'm sure you're aware that over the years, unless we're in a real bad down year, for the most part, the calls, the market tends to move up mostly, and the calls are the upside is what generally gets hit when you're making adjustments. So I've noticed that to be true over the years that I've traded, probably about 75% of the time. So that's also one of the reasons why I think this trade kind of came about the way it did, to not have to mess with the call side as much, because that's the side that's always generally most of the time getting hit, but making sure that there's a lot of risk management on the downside for those big swings down when they do happen. And then I also like to put on an additional long put, and generally it's placed at the long of the put credit spread or lower, could be placed a little bit lower, and that basically helps smooth out the T+0 line on the downside, so not having any quick downward slope. And my exit for this trade is generally 14 days to expiration. I don't want to take this into expiration. It's really difficult at that point, and once you get within the last week, for sure not, but even within the last 2 weeks, the risk doesn't seem to be worth the profit potential, because it's about at that point, depending on where I am in the trade, I've pretty much made most of the money that I want to make. So with that, I'm going to go through a couple of recent examples of trades this year. Yep.
Amy, one of the questions was, the overall position, do you have a particular delta? Do you try to start the entire trade as a negative delta, or is that not part of your parameters when you start?
Actually, yes, that's a good point. I want it to be under a 20 delta, positive 20 delta. I prefer it to be as flat as possible. I try to get it around a 10 delta is generally where it should end up on a one tranche. That's the other thing I'm going to talk about. There's a certain ratio of put credit spreads to put debit spreads to call credit spreads and so forth, and that ratio, a single tranche of that ratio, which is what I'm going to show in my example for simplification, should be around a 10, don't want it to be any more than about a 10 delta, definitely not more than a 20 delta, but, it depends on the volatility currently in the market and what kind of prices I'm able to get, but generally it's got to be under a 20 delta, prefer more like a 10 delta or less for the whole position to start off with. So with that, so what I thought I'd show is a couple examples of trades this year, very recent, September and October expirations. That is just a perfect, I think a couple of really perfect examples to show, and you'll see why as I go through them. But the September expiration, 2014 expiration, and I also, another thing just to mention, I don't generally do these in the weeklies. You can. I think probably the SPX might be better choice to do them in the weeklies because I think it has more, a little more volume and liquidity than the weeklies in the Russell 2000. But I'm generally just doing these in the monthly cycles. So this is the September 2014 monthly cycle, and at the time that I got into the trade and afterwards, we had a kind of a downturn for a while. I entered the trade on August 4th, and before that we had kind of a downturn, and we were kind of coming out of that at this point. And so this is a nice example because obviously I didn't know it at the time, but what ended up happening was the Russell 2000 moved quite a bit higher during this time, and which of course caused me to deal with this trade a lot on the upside of making adjustments on the upside and what can happen. So I thought this would be a good example to start with. So as you can see in the graph here, the trade launch was a Monday, August 4th, 2014. There were 45 days to expiration, and the Russell 2000 at the time of the trade being put on was, and I think it was in the morning sometime, which is usually when I like to do things, was 11:15. And we had gone through kind of a choppy area, but we had gone through quite a bit of a downturn, and we were kind of pulling out of that. Of course, I didn't know that then, but it seemed like this would have been a good time to put on the trade. I didn't want to wait any longer. Things seemed to be stabilizing, and we had already been kind of had already been in an oversold position. So I felt pretty comfortable putting this on at this point. So here's the candle of the August 4th when I put this on. And with that, I'm going to go through, and I'm going to use a software program, one, to actually go through the trade. So I'm going to hop out of this presentation and go into the actual software to show this to you. So everything, makes sense here.
Hey, Amy, while you're switching, we had a couple of people asking in the chat what 5% probability out of the money, or 5% out of the money means. Is that 5% above the current stock price? Or index price?
Yeah, exactly. So if the RUT is at 11:15, it should, the short on the call, for instance, should be at least 5% out of the money of 11:15. So whatever 5% of 11:15 is, so you could just take 11.95 minus 11.15 and calculate. I use a little spreadsheet, but you can calculate and make sure that 11.95 strike is at least 5% out of the money, above the current price of the Russell 2000, which is 11.15 at this particular point.
Amy, with the IVs this slow, though, how much are you receiving in that credit spread? I'd imagine it's pretty small.
Well, at this particular trade, and actually most of the year the IVs were really low. This one it kind of has popped up a little bit only because we had just come through that big downturn. But that's one of the things that when it's a lower volatility market, it's hard to get a lot of premium. But as long as so what I noticed in those markets, I'm not able to get as far away from the current price of the Russell, but I'm at least able to get 5% away, and I don't want to be more than let's say a 12 or a 13 delta in those really low volatility on the call, although I'm not defending that much. And on the put, I definitely don't want to be above a 16, but I'll be closer to a 16 delta on the short put of the credit spread in extremely low volatility markets. But in this particular case, I'm not extremely low volatility, and I'm able to get even further away and still get some decent premium. So yeah, the premium shrinks, but you kind of make up for it by getting a little bit closer to the money. But it all kind of, it still falls within the rules of the delta and the percentages of being out of the money. So the 7% is really the lowest on the downside. 5% is the lowest on the upside, and then 12 delta or less on the upside and 16 delta or less on the downside still comes into play even in the lower volatility market. And then I'll go through, obviously, for this particular one, each individual price that I'm paying for each spread or getting for each spread. So basically, this trade is already in here. And what I've done for simplification purposes is just created a one tranche trade. I do multiple tranches, and then I also stagger into them. So sometimes I'll have more than one put credit spread. I might put half of it on one day and half of it on a few days later. And as the market moves, I might have 2 different strikes for my credit spread and so forth. But for simplification purposes, I wanted to take this trade as the very first tranche. I think I did all of the tranches exactly at the same strikes, actually, on this particular one. But I just cut down the number of contracts so I could just show you a single tranche. So basically, the first thing I like to do is work on the put side to figure out what I'm going to get. So the first thing is real simple, is, okay, I'm at 11.15 on the Russell. I want to be anywhere from 10 to 15 points below the market on my put debit spread. And actually, before I do that, let's see. I don't know why that one screen keeps popping up there.
So Amy, while you're switching screens, a couple people asked, do you wait for a down day on the Russell to enter?
I prefer to wait for a down day. It just makes me feel more comfortable. Usually you get a little bit of a volatility pop depending on what kind of down day it is. And also, I feel a little more comfortable that when, if we do continue to go down, I've already gone down a little bit from, that much further away than where I would have been had I put it on the day before. But I also want to make sure I get into these, I don't want to wait until the very, for instance, let's say I start looking at 55 days for a down day, and I don't get a down day, and all of a sudden it's like 42 days. I probably could have been further out of the market had I put the trade on at 50 days and had I waited. So I won't wait forever, but I do prefer to have a down day, so I'll take advantage of it when I get it. But there's been plenty of times where I've, gone in on an up day. As a matter of fact, this day was an up day, but we were just coming off a really big down move. So I felt comfortable just for that. Like I felt, okay, we're kind of stable. Maybe we're going to be stabilizing. I've only got 45 days left to expiration. I really want to get into this trade for the month. We're kind of, in the oversold kind of category at this point, so I feel pretty comfortable. So even though this wasn't a down day that I put it on, we're only up 66 cents at this point, I felt comfortable putting it on at that point. So it's not like I have to put it on a down day, I prefer to. So there are some nuances with this. It's not as any of the trades I do. They're not really black box trades, but I just go by the general guidelines and then kind of follow those. And then, of course, there's going to be some, you know, trader, whatever you want to call it, trader's choice options as you go along, depending on what I see. So, and I'll go through what I'm looking at once the graph is built. It'll make a lot more sense. So again, the first thing I do is I look to see which debit spread I'm going to put on. So 10 points below is about at 1105, and 15 points below is at 1100. I'll put these on the fives on the Russell 2000. They're not as liquid, but they seem to do fine. But in most cases on the very first debit spread I put on 15 points, I prefer not to pay as much, so 15 points usually works out pretty good. I don't pay quite as much, and in this case it's on the 1100 strike, which is going to be a little more liquid. So I decided to do that. So I'm going to separate these so you can see as I'm building the trade. So it's costing me $6.35 for this spread. And as you can see, it's basically what's giving me it's going to give me some protection on the downside if for some reason the market starts to move down again, my put credit spread will get hit, but I'm going to have some protection from this put debit spread in front of it. So, and it also helps with the margin as well. Then the second part that I like to look at is the put credit spread. So in this particular case, I definitely want to be, like I said, under a 16 delta for my short on the put credit spread. And I want to be at least 7% below the 1115 price, the current price right now. And because the volatility is up a little bit at this particular time when I put this trade on, I'm actually able to go, a little bit further. So I'll play around with that, and in this particular case, I'll try to go as low as possible. So let's say I try to look at the, let me get rid of the put debit spread. Let's say I start over here at the 1,000. Oops. And just put one in, 20 point wide, getting $1.65. That's pretty good. That wouldn't be a bad choice. I wouldn't be able to go any lower than that. And if I went, what I ended up choosing was this particular strike, which is a little bit higher. It's still below a 16 delta, bringing in a $1.95 premium, which is closer to what I like. I like to get anywhere between, $1.60 to, $1.95, $1.90 on the put credit spread. That usually works out pretty well. So in this example, I ended up, or this particular trade, I should say, I ended up choosing the closer 10-10 strike. Part of that reasoning was probably because we had just come off a big down move and I felt comfortable going up the strike, but had we been in the middle of a down move, I probably would have been trying to go further away, which would have been the 1,000 strike. But I decided to choose this one. So my structure for this is basically I want to do, for one tranche, I want to do 10 put credit spreads, and to balance that out, one put debit spread. So I end up looking like this, which obviously, we're immediately going to start losing some money, even though this put debit spread is helping out. I'm going to immediately start losing money if the market moves down. So I want to balance that 2+0 line out. And the way I do that to start with is to sell some calls on the upside to kind of balance that out. And I like to just keep the ratio simple. Sometimes it doesn't have to be this way. I could do something like let's say I want to take my delta down to 12 or half the delta. I could, or maybe make it down even closer to 0. I could do 3 call credit spreads. But I like to keep just a single tranche very simple and do just 2. So it's 1 or 10 put debit credit spreads to 1 put debit spread to 2 call credit spreads. So I'm not really putting on a lot of call credit spreads, but I'm putting on enough to basically cut the delta in half from where it was before. And then to further flatten out the T+0 line, I like to add an additional put, long put. And sometimes I'll add it, a lot of times I'll add it closer or at the long of the put credit spread in this particular case. But usually I don't want to spend more than $4 on it. So in this particular case, I chose the $9.60. And that flattens it out a bit more. So now I'm at a 6.5 delta, which is under a 10 delta for one tranche, which is pretty flat and manageable and so forth. So that's kind of how I build a single tranche. Of course, I do more contracts than that, but that's the basic structure of it. I was experimenting at the beginning with putting on more calls, like let's say 3 calls, maybe a little bit further up to get to the same delta, and putting on a single put even further out of the money, so I didn't have to pay for it as much. But because most of the time the market tends to move up and I'm getting hit on these calls, I don't want to defend them, but I also don't want to lose a lot of money on them. So I just felt that the combination of 10 put credit spreads to 2 call credit spreads seemed to be a good combination, and not, I'm not losing a lot of money if the market continues or the market moves up and I end up getting hit on my calls. So that is what the trade looks like at start. And then I do a couple of other things afterwards. So I figure out where I'm going to be. And then once I figure out what strikes I want, I start to build the position by first making sure that I get my credit spreads. But I want to make sure I get the price of my credit spreads. I mean, I'll give them a nickel or whatever. I'm not always going to get the mid price, but I want to make sure I get my credit spreads, because if I don't get these and I get something else, then I'm going to have to rebuild the trade based on the ones that I'm going to be able to get. So I'll have a couple different options. Usually I use Thinkorswim. I'm sure some of you use Thinkorswim, some other platforms, but in Thinkorswim, I'm able to put in simulated trade. So I'll probably build a couple different versions of this to see, and then work off the one. So I know what I'm going to do ahead of time, but my first plan is going to be the one in place with the hopefully being able to get the prices that I want. And if I can, then I'm going to continue on that path. So the first thing I like to do, again, is put on the put credit spread. Once that's filled, I immediately put on the put debit spread, so I want to protect it. And usually that gets filled pretty quickly. This is only, for one tranche, it's only one lot, not a lot less. And then I'll put on the call credit spread and even the extra put. I can put those orders in at the same time to balance out the trade. And usually I get filled pretty quickly on these. I don't like sitting around and waiting, so sometimes I'll wait a little bit for my credit spread because I really want to make sure I get that price. But on the others, there's not as many contracts. I'm usually filled a little bit faster on some of those. So, of course, if the market is moving at the time, sometimes, as you know, it can be hard to get filled, especially if it's moving in the opposite direction of what you want. So, or what's going to be beneficial to the price is what you're trying to get. So that's how I build the trade as a single tranche. And once it's built and I actually have the orders in place and filled, then I'm going to go in. I'll go in ahead of time too, but generally I want to make sure I know what I'm working with first. And I usually have time to go in, and I'll do a couple things. First, I want to make sure that I have contingent orders in place in case the market moves up, and contingent orders in place in case the market moves down, just for the first couple things that could happen, so I don't have to sit around and watch my computer. So with my condors, my nested condors, I can really take a big move. So a lot of times I'll just put in alerts for those and then take care of a really simple trade even on my phone if I need to. But with the Weirdor, the market doesn't need to move quite as much in order for me to trigger a trade, because I want to keep this line as flat as possible. So I'm putting on, I'm actually doing a little more trading with the Weirdor, and I have to keep more of an eye on it than I do with my nested Condor. And so in order to deal with that and not have to sit in front of the computer, I like to put in contingent orders to start with. So the first thing I do, really, really simple, is on the calls, since I don't really want to defend them, I'm going to take half of these calls off if I can do it either of two ways. One, I can look at the spread, what I sold this for, and as soon as it gets to 1.5 times of what I sold it for, I'll buy back one. Or with Thinkorswim, it's easier actually to just put in this particular strike once the let's put in my original price. So once the original price is 1.5 times the original price of the short, then I'll go ahead and buy back one of the spreads. And it'll be approximately about the same as 1.5 times, maybe a little bit more than 1.5 times what I received for that spread. And then I'll do the same thing for the other half at 1.75 times, 1 3/4 times. And that's it. I really don't want to mess with these calls. I might do there are some other things that I might do. I could roll and so forth, but the basic guideline rules that I use for this without any additional trader's choice rules that may come into place depending on days to expiration, overbought and oversold conditions and so forth, for the most part, I'm just taking those off if that happens. And I'll put two contingent orders in, one for 1.5 times the price and one for 1.75 times the price to get rid of those and just close them out. And then I'm going to put in one more contingent order on the downside to start with, and that is to buy an additional put debit spread. And the way I choose where that's going to happen is in a couple ways. One, I kind of look to see, in one day, what's the one standard deviation move? And in this case, it's about 13 points, 12, 13 points, something like that. And then the other thing I look at is the average true range at the time, which in this case is about 12 points. And at the time. So I'll kind of, I'll usually swing for the higher one of those. I usually go, lately I've been doing about 14 points. I think I did about 14 points with this one as well. And I also like to, bring the bar here and kind of look, well, where would I be if we were at, say, 1100 or 1101 or something like that. And for one tranche, if I'm down about $200, that's about where I'm going to place my contingent order to be triggered. So for the very first contingent order on the put debit spread, those are the three pieces I look at, and I decide which one I feel most comfortable with. Down $200, hold on one second. Okay, down $200, or I'm going to use my average true range or 1 day standard deviation. They're all going to be close to the same, but I'm going to pick one of those. And generally, I tend to do closer to the $200 down, about 14 points. In this case, about 15 points. So I would put in a contingent order that would say something like, if the RUT is at or below 1100 or 1101, buy a put debit spread, and I'm going to buy a single one. So for each tranche that I'm doing, I'm going to buy one more, and I'm going to buy it about 10 points below where that price would be. So if I'm at 1100 or 1101, I'm going to buy it at 1090. So I would actually put in a contingent order to buy one 1090, 1070 put debit spread if the RUT gets down to 1101 or 1100 or below, and just trigger it and just buy it. And then after that, if it's triggered, I would put in another contingent order to go below that. So those are the three contingent orders that I always start off with when I start.
Hey, Amy, on your contingent orders, somebody asked you add 5 or 10 cents premium over the mid on your contingent orders?
Yes, I do. I add anywhere from 5 to 15 cents just to make sure they get triggered. Usually 10 to 15 cents is better. Otherwise, something might get hit, but it won't get filled because the market's moving fast. Usually if you put in enough, I think Dan Harvey puts his in at 25 cents. But you definitely want to add at least a dime or more. I prefer more to make sure that the order's getting filled, but at least a dime. I do sometimes, a dime or 15 cents. I don't think I've ever done more than 15 cents, and I've always gotten filled. Okay, so that's so far so good. So anyway, so that's the beginning of the order. So now I've got my order in, I've got my contingent orders in, and I'm ready to start, you know, the trade, or well, the trade's going to start already because I put it on. So basically, on August 4th, I'm just going to go to the end of the day, because one nice thing about this program is it has a little, well, you can't really see it here because it didn't move very much, but there's a kind of a shaded red area that kind of shows where the market moved that day. And then, of course, there's a high and low. I'm just going to kind of follow this. So as there we go. Here's that shaded line. So I can kind of see, like, you know, that whole day, this is where the market moved. It ended up going up. So I'm going to change that to the original price. So basically for this one, the original price was $3.25. So 1.5 times that is going to be somewhere around 5 something. Let's see what that would be. We can bring up a little calculator. So 325 times 1.5. So if that got to about 490, something like that, I'm going to take off the first one, and if it gets to about 570, I would take off the second one. And then, of course, I've got my contingent order for the downside for the movement of the Russell. So, I'm just going to continue to go forward. And so far, nothing's getting triggered until the 11th. So we can move forward to we get to the 11th. So let me go back. It's happening in the morning.
Questions while you're moving there. Bob probably asked, do you have the same 15 cents on both sides or larger on the put side on your contingent order?
I think I do the same most of the time. Generally the same. If I pick 10 cents, do it both sides. But I've been sticking with 15 cents lately, and I seem to be getting hit. You know, they fill. So I think that's pretty good. I probably would be okay with 10 cents too, but I just don't want to take the chance. 15 cents, I guess, might be a little bit small. Maybe 20 cents is better, but 15 cents is just try. I've done 10 cents before, and it works. But lately, I've been kind of the movement of the market has caused me to increase that. So.
And then Luke asked, how frequently do you check the position?
I check the position every day. Generally, what I like to do is, you know, see where the futures are in the morning before the market opens. Usually the first half hour, the prices are kind of wacky, so sometimes if I'm really close to a trigger point, I might actually stop it from triggering for the first half hour of the day. Sometimes I just leave it alone. But I usually watch the market for the first, you know, if I'm doing other things, for the first, you know, hour, 2 hours, 1.5 hours as I'm getting ready and doing other things. And if something gets triggered, I'll put on another contingent order. And then I'll have, you know, set alerts throughout the day. So if something gets triggered, I know what's happened, so I can, you know, put on another contingent order if I need to. And then, you know, if I'm around my computer, I'll look at it at the end of the day. But I've got a pretty busy schedule doing other things. So if I'm at home, I probably usually just keep my computer kind of on the background, and every once in a while I look at it. And if I'm not, then unless something gets triggered, I really, the main time that I look at these is in the morning. And, you know, in that way I can also make a plan, you know, or sometimes like after the market ends, like that night or something, I can make a plan as like, well, if something like this happens and I'm kind of in a weird position right now, I've already had a couple of adjustments, what's my best move? So I can kind of go into one and model some different options and see what would be what would work better if I did this or that or whatever. And that's only after a lot of the adjustments have already been made. The first two adjustments are basically just get rid of the calls or add debit spreads. But if I'm, you know, if we're really starting to move down, then it starts to get to the point where do I need to take off some credit spreads? Is it better to just take off the whole trade and you know, move it, that kind of thing? And that's something that I'm going to show as I go through these examples in the October example as well. So, okay, so basically moving forward here. So on the 11th, let's see the time. I'm kind of running. I hope I'm not running out of time here. I am. On the 11th, what ended up happening was the first calls got hit in the morning. And so my order got triggered, and I bought back one of the call spreads. So basically that moves this line down a little bit, taking away some of my profit potential, but it's flattening out my T+0 again. Now I'm pretty much flat delta. And I still got plenty of profit potential. There's one thing that I forgot to show, I apologize. But when I first put this trade on, let me go back real quick to the 4th. I always like to check my target exit date, which is 14 days to expiration, just to kind of see, like, well, you know, this is my target I'm looking for. I'm probably not going to get that full amount of money because I'm going to have to put on some adjustments. But, you know, I'm always kind of aware of what kind of target am I looking for, 8, 9%. I'm probably, you know, I'm happy with 4 to 6%. Well, I'm happy not making a loss, actually, but usually somewhere in the 4 to 6% range. So let me move forward again to the 11th. Actually, let me just see here. So originally, I was looking at, you know, trying to make about $1,400. Of course, there's going to be some slippage and commissions. Actually, I think this program actually takes all the commissions into effect. And I'm probably going to have some adjustments so that, you know, realistically, I'm looking for about 1,000. But no, I'm going to have some adjustments. So let me go forward to the 11th. And now I've got, oops, that's a little too far. Okay, so I've taken off one of these. But if I look, I still have a lot of nice profit potential there, $1,000, which is, you know, I'd be happy to get that. I can get a little bit more. Now, you know, obviously, way over here, I could really hit the jackpot if I start getting close to expiration over here, but I'd have to take it into like the last week of trade in order to get that. And what I found is taking it in within the last 2 weeks of trade, especially the last week, I could end up, you know, losing a lot of the profit that I've already made. So unless I'm really in a super sweet spot of a flat part of the T+0 line, 10 points in either direction, like all the stars align and everything, I'm not going to take it that far. So, anyways, let's go forward a little bit further. And what ended up happening, my other calls got hit. So now I'm out of the call. And as you can see, I'm still, you know, pretty flat delta, but I don't really have anything balancing out this side. So, you know, I could start losing money as I go down. So what happens at this point is I basically make a decision, you know, I can keep the trade on and maybe sell some more calls further out of the money if I feel like, you know, maybe we're in an overbought position. Or I could just take it off and reposition the whole trade. And so sometimes I wait and see what's going to happen, let it go a little bit. And so in this particular case, what I ended up doing was just that. I ended up just taking it a couple days forward, and I decided on Thursday, you know, I'm just going to take this thing off and reposition the whole trade. I don't want to put on any more calls. We're still moving up. Let me just reposition the whole trade. I'm not, you know, I'm not going to get much more if we go this way. I'm risking too much, you know, to go down here because if we do start going down, I'm going to have to put on some put debit spreads, and then I've lost money on my call credits and so forth. It's just better to reposition the whole trade since I have 36 days left to expiration. So it's kind of a really short window date to expiration, but and I wouldn't put on an original trade from the beginning this short to expiration. But if I can get good prices, I will put on a second trade to try to make the same amount of money that I was going to originally make. So that's what ended up happening in this particular case. So what I ended up doing was closing that trade for a profit and then putting on a completely separate trade. And I did exactly the same thing, same rules as before, obviously different strikes. But I did about approximately about the same delta for the whole position. So, and then at that point, I also put on my contingent orders as well. Now the difference, when I first started off the original trade, I was able to get a little bit further out of the money. And in this particular case, it wasn't quite as far, but I'm still, you know, a little over 7% out of the money on my puts and 5% out of the money on my calls, on my short calls. So I still felt like, okay, I can put this trade on. It's better to reposition, take a small profit, and see if I can make a full profit on this one. So now I'm looking, same thing, 14 days to expiration, trying to make another 900, which maybe I'd be happy with about 600 or something, or 650 from that. So that plus what I've already made on the other trade, which I think was almost 400, would be about where I was hoping for on the original trade. What I do with this one is put in my contingent orders the same way I did before, and everything's going fine on this trade for a few days until I hit the 19th. And then at that point, my first call gets triggered. So it's continuing an up move. My first call is getting triggered. So I go ahead and remove that, and then keep going, fast forward a few more days. Whoops. Let's see. That's the right one. I think I forgot to put it in order here. The problem with rebuilding these things. The second call order should have been removed. Oh, I see what I did. I'm sorry. I apologize. I did remove that. So the first, we go back to, oops. Okay. So what happened was I had my second call order of the 1200 strike triggered. And then what I decided to do was, okay, should I just take this off and just, okay, take a little bit of profit here, take a little bit of profit before. And I was kind of looking at the chart and I thought, well, we're not really overbought, but, you know, we only have, I think we have limited upside from here. At that point, maybe we're due for a little bit of a pullback. So I felt comfortable with 25 days, you know, can I get anything? Should I try to flatten this out a little bit and stay in it a little bit longer? So in order to want to stay in it a little bit longer, I wanted to put something on the call side. So I ended up putting on just one credit spread. Just a decision. When did I do it? About 735. Here we go. 10 points higher. So I got a little bit of money out of that, kind of flatten that out a little bit, just to see if I can pull out a little bit more money from this. I'm not going to keep it for that long. So that was kind of one of those trader choice decisions that I decided to make, and just do one to try to make up for that, the loss that I made on the other two call credit spreads. And that seemed to work out fine. And I just basically continued on until the 3rd. Well, basically, so that this is the target of where I'm trying to get. I want to try to get at least into the next week. So Monday's a holiday, so I know I'm going to have some good theta decay over the weekend. So fast forward to the 2nd of September, we moved up, but because even though I'm kind of getting close to this call, because we don't have very many days left, it's actually cheaper than what I sold it for. So I decided to stay in. And then I'm thinking, you know what, I probably don't need to take this all the way to Friday. There's no reason to take that risk. There's really not much left in the trade. So a little bit, so the next day, decide, you know what, there's no reason to stay in this thing. I probably should have got out of it even the day before. I went ahead and took it off. So basically, I was able to do 2 cycles in the same month because there was a continued up move. So let's see. So let's go to the next page. Here we go. So basically, it shows here trade 1 and trade 2. So trade 1, I was in the trade for 10 days, and I made $436, about 2.5%. In trade 2, the second, because I had enough days to expiration to just reposition the whole thing, I was in that trade for 20 days and made an additional $530 or 3%, which ended up to be about a 5.5% profit for September. So it was more beneficial for me to, because of the continued up move, to get out if I, and reposition the whole trade and just try to stay in the trade. I wouldn't have made as much money. So that worked out on a nice up move. So that's kind of a good, I think, example of what happens when the market continues to move up quite a bit, which has been happening quite a bit lately. And
Amy, is that 5.5% based on the margin used or planned capital, or how do you calculate that?
It's based on the margin. I just got that from the One software. It basically on the margin used, the maximum margin used is what I have the setting for.
Is it fairly consistent, or does it vary a lot?
The percentage profitability, it's...
No, the amount of margin that you use.
Oh, yeah, it's very consistent. That's a nice thing about this compared with the nested Condor or any Condor, or well, I shouldn't say any Condor. The way I do the nested Condor is I tend to, roll my bad sides and increase contracts. Of course, it doesn't necessarily happen much. You don't have as much trading going on there as you do with the Weirdor, but I have to put the margin aside in case I'm going to have adjustments like that. In the Weirdor, you're set from the get-go. It fluctuates a few $100s on a tranche, but not really much. It will fluctuate more in portfolio margining, but for different reasons. But if it's just a Reg T margin, your margin will basically remain the same throughout the trade. It'll fluctuate very little.
And a question if you have to buy more debit spreads, but I've found that actually reduces your margin.
It definitely reduces the margin in a portfolio, and it'll reduce your margin. I think it reduces your margin in it'll definitely reduce your margin in a Reg T as well, because you don't, for instance, if I have 10 credit spreads here, and then I buy 1 credit spread here, my maximum margin is really only 9 credit spreads at 20 points. Forget all the money that I'm taking in, just the basics. So if I bought another debit spread, then it's really like only having 8 credit, if I went ahead and I bought another one. Oops, let me combine those. It'll drop it down by the amount that's, 20 points, about $2,000. Because I now have $2,000 of less risk, because now I'm really only short 8 instead of 10, now that I've got, 2 of those. So that'll change, but it won't go up. If it goes up, it'll be in a Reg T. It won't go up, actually. I don't think it's possible.
It lowers Reg T. It lowers portfolio margin even more so, because the thing is that they have, when they do the portfolio margin, they're actually looking at basically your delta risk, and as your delta risk changes, with gamma going out, so it reduces it with both a greater percentage on Reg T. I'm sorry, on portfolio margin more so than Reg T.
Right. So, whoops, where was I? And these examples are all from, but that's what I noticed, is that it's just basically, it keeps very steady throughout the trade, which is nice. So there's no surprises. unless, there are, again, trader choice things. I mean, if you want to add more credit spreads on the call side or do some kind of rolling and add additional credit spreads. Again, actually, if you do that on the call side, you have to exceed the amount of credit spreads on your put side on the Reg T to affect the margin, because it's only going to take the worst side. So that wouldn't really affect it either. But it would in the portfolio margin account. So I think I ran out of time, but I can go through really quick the October 2014 expiration example if everybody wants to see it, or I can come back, or what do you think?
Well, it is at an hour, so what do you think?
This is an hour? Oh, it's an hour, okay. I can continue for a little bit longer and just go through this one.
Okay, Chuck says you have lots of time. And there was another question, have you looked at using naked calls instead of call spreads in a PM account?
I've never done it, but it's, I don't see any reason why not. Again, I'm not really defending them, so I would probably just put in contingent orders to get rid of them before they get too expensive. And then that way you can maybe, hopefully get a little bit more out of it, a little more juice, flatten it out a little bit, get a little more premium in. And I would do that as long as I'm, my rules would remain the same, though I probably wouldn't defend it. I'd just, get rid of them about the same time I'd get rid of the spread.
We had a couple of votes to keep going, so if you have the time, we'd love you to keep going, Amy.
All right. If you have a Reg T, you couldn't do that, but obviously the portfolio margin you could. So. Okay, October 4th. So basically my next example is the very next month, which I think is another great example. And in this particular case, as we all know, the threat was really coming down quite a bit. We had some really choppy action, especially towards the end of this cycle. And there are all sorts of weird global stuff going on affecting the market. There was like the Ebola stuff and ISIS and Hong Kong and Europe, going into recession, all this kind of thing. And of course, it was all played out in the news quite a bit, so making people nervous, the market for all that kind of stuff. So even though the Russell had already come down and not really got back up to the top, the rest of the markets did. So lots of concerns out there. So basically, as you can see here, when I put this trade on, it seems to be kind of consolidating, stabilizing a little bit, and there was concern about big down move, but people have been talking about a lot. At the beginning of the trade, I don't think there was any huge. The biggest thing I think was in Europe, and I think maybe ISIS was in the news. I think it won't up until a little bit later. I'd have to go back and check the news cycle. I think again it was like, well, it could go down, but again, I like to just. I don't want to wait too long. I was even waiting on this one for what I thought was maybe a bigger down move to get in, and I wasn't getting it, and I was running out of time, so I wanted to put the trade on. So that's why this one only had 42 days to expiration. On Friday, I wanted to State indicator of the region, and the rut was at 1165. So, oops. So now I got to go into one. So I'm just going to go through that. If I can open this up, there we go. So on 5th of September, I went ahead and put this on. Same rules as before. I had to go in a little bit, well, actually that's not true. This is 10:30. I put this on a lot earlier in the day. For some reason, I know I put this in my notes here. I had to get a little bit closer on the calls, about 4.7% out of the money, but I really didn't like the premium of the 1230, 1250 calls. That was the reason why I decided to just go ahead. I'm not going to keep them anyway for very long if the market starts moving up. So I guess the premium here was like $1, 25 or something like that. It was just too low. In hindsight, it would have been probably fine, but I thought, let me just put it on a little bit closer. There's only 42 days to expiration. You know, maybe I could have gotten a better price a few days ago or something. On the puts, though, I did get, you know, below the 16 delta and over 7% out of the money on those. So everything was put in place. I put my contingent orders in, like I talked about before, and the market started moving down. So basically, this trade actually was moving pretty, wait a minute, pretty good for about 10 days, and it wasn't until the 15th of September that I hit a downside trigger. Market moved down enough, or the rut moved down enough to where I hit a trigger to put on an additional debit spread, which I did. And as you can see, I kind of flattened things up a bit. Let's see if I can go back. 647. So here it is before, and here we are after. So I just took out, just flattened it up a little bit. And then I chose, because that was hit, I actually chose another downside trigger. So again, probably another about 14 points away, I would trigger another one. And on the 22nd of September, a week later, that is exactly what happened. So I ended up triggering a third debit spread. So now my graph kind of looks kind of funky. It's like, well, I'm not going to make any profit if it goes up. But what I like to do is forget about looking at that side on today's graph. I like to look at it at my exit point of where I'm trying to be. In 11 days, I have my exit target date. I still could be quite profitable if I take it in to my target date. And I'd rather not chance that it continues to go down and not put on another debit spread, even though I've only got 11 more days to my target date. So I decided to do that. And then I also decide, I start looking at these, I'm thinking they're not doing anything for me, and they're, you know, there's just not enough deltas, not doing anything for me, and the price is really cheap. I might as well take off the calls. Maybe I'll, you know, well, I probably wouldn't have a chance to put on any more because there's not enough days left in the trade, but I might as well just take them off. So for some reason I decided I'll just take them off. So I did a little bit later on in the day. Let's see. $9.22. I thought I took them off. Oh, maybe that's the wrong date. I don't know if I have that note in there. Oh, I'm sorry, I didn't buy back the call spread. I thought about buying it back because they weren't helping the position. That's just an option that you could do there. I didn't actually do it, reading the notes properly. But on the 23rd, go to the beginning of the day, market started moving down again. So what ended up happening was, as it did that, I started looking at I've already put on 2 adjustments, and now I'm looking at my put credit spread and deciding, you know, is it better to put on another debit spread, or is it better to start taking off some of my credit spread? And obviously, if I start taking off some of my credit spread to fix things, I don't have as much profit potential because I'm losing my way of making profit in this trade. But I don't want to keep on a lot of risk either if the market continues to move down. So I have to decide whether, you know, sometimes it's worth it to put on another debit spread. Sometimes it's better to just take off some of the credit spreads and fix the T+0. So in this particular case, I decided to do exactly that, is to take off a couple of the, we get, you know, that 25 delta here on the short. This is just going to keep getting worse. I decided to fix this trade by taking off a couple of the credit spreads here, flatten it out, which it did quite nicely, and still, I can still make a profit in the trade. At this point, this might be, an unprofitable trade, but one of the nice things about this is with the Weirdor, I try to keep any losses, much lower than as percentage-wise than a win, whereas with the Condor, usually a loss is like 1.5 times a win would be the maximum loss. In a Weirdor, I want to keep my maximum loss of, maybe 2%. So the graph over the whole year is a lot smoother going up, because it's supposed to be a little choppier with the Condor. So let's see what I say here. So basically, it's Tuesday. I've got the rest of this week and one more week to be in the trade. So I decide, okay, that's my normal target date to stay in. But there's all this stuff going on. ISIS, Hong Kong, Ebola is now coming up. The seasonality thing, people are getting nervous, all that kind of stuff. So what ends up happening is I decide, do I really want to take the risk of taking it into the weekend, or should I just get out of this thing? It's not like I'm going to make a huge amount of money on this trade if I wait, and maybe it's just better to just say, this one wasn't so great. So what I end up doing is exactly that. Instead of taking it into the weekend, I take it almost to the end of the day on Friday to get as much, just kind of watching the market. This is one where I'm probably going to watch the market if I decide to do something like this and not run around all day. And basically I take it in toward the end of the day and decide I'm just going to take a small profit on this thing and just be done with it. It's just, I didn't make a loss, fantastic. It was a really kind of a wild month. So that's pretty good return for a pretty crazy month. So that's what I ended up doing. I went ahead and took it off. And, oh, it's showing me the next trade, sorry. I went ahead and took it off around 12:35. But as a bonus, so I was in the trade for 20 days, and I made about $388 for the single tranche. Of course, it'd be a little bit different because I had commissions and slippage and so forth. That would be a little bit different doing multiple contracts than just a single tranche, but about 2.32% was the profit. But as a kind of a bonus, what I thought was, well, what if I wasn't listening to the news? Come on, here we go. What if I wasn't listening to the news, or I didn't care, and I just wanted to take this thing into expiration week, like I normally, or expiration week, into my target exit date, just like I normally would, if all this other stuff wasn't going on. So I went ahead and I created this copy of my trade, and then just erased the closing trades and just said, well, what if I took it into the following week? So I went ahead and did that just to show what would have happened. And what was happening was basically the market continued to move down, and my thinking, if I was in this week, my thinking would be I don't necessarily have to take it into Friday. So basically I kind of put in a target saying, well, if it gets down towards like 1,100, so a nice round number, it's getting close to my shorts, which are at 1080. That's like within 20 points, which is really kind of way too close for comfort. But, I want to watch this thing, and unless it goes down into negative territory where I'm not going to make any money on this trade, I'll stay in it until the end of the week. So that's kind of what I would, if I were to do that, that's what my thinking would be. It's like, well, if I'm going to stay in for another week, I might as well see if I can at least make some more profit on it than I would have, but I don't want to make a big loss. So as soon as this thing gets into negative territory, or, within $100 or something like that, negative, I would just take it off. And so that's kind of what ended up happening, is had I stayed in, I would have kept it until that small loss developed and gotten out, and that's exactly what ended up happening. And it happened on the 1st, actually. So what time? I'm not sure exactly what time. I guess earlier than, but sometime between 6:30 and 7:30, I got into negative territory, I guess. Probably somewhere between that, and decided to just take it off. And then, in that case, it's like 1093. I'm 13 points above my short, which is just not worth it. So definitely take it off. So even though it's only Wednesday, I would not take it into Friday. So that's kind of how I would deal with something like that if I did stay in. So basically, if I did shoot for the target exit date, I would have been in the trade for 6 days. I would have had a loss of $27 or negative 0.16%. So that's kind of, sorry I had to go through that one kind of quick, but that was how October worked out. But the nice thing about this trade is it keeps things pretty smooth, even in a really, I think those were two good examples of months that were really kind of, pretty crazy. I mean, this one was going down quite a bit, from 1165 all the way down. Where did we get down to? In a month's time, we got all the way down to like 1050, almost 1040 over here. And as you can see, we had some pretty big moves, and we had some pretty choppy moves where we'd be down a lot one day and then up the same amount the next day, and then down a lot and then up and so forth. A lot of that kind of stuff going on. You can see it here. I don't know if you can see my cursor here. So there was all sorts of weird things going on, and still the trade was still capable of being profitable or just making a very small loss. And then with the September trade, starting at 1115, and this market ran all the way up to 1180. Most of it up days, but some choppiness, but some pretty big moves going up within a month's time. And because of that up move, that's one thing I like about this. 75% of the time, the market tends to be in an up move, where you tend to have adjustments on the call side. If those adjustments happen quickly, I'm able to reposition the whole trade and then try to make profit on the new trade, just like I was from the original trade. And a lot of times end up making the amount of money I was looking for, sometimes more. So that's the presentation. Any questions?
Yeah, Amy, somebody asked, this is what you're trading right now, right? You don't have a different strategy you're using?
This is the main strategy that I'm using right now. I only have so much margin to work with, so I prefer to have my nested Condor and the Weirdors on, and I did for a little while. But I really wanted to play around with this trade over this year. So in 2014, my main trade has been this one with an occasional nested Condor. Definitely been keeping track of how the nested Condor, as far as a non-live trade, I've been doing that, keeping up with it. And what I found, though, is because of the way it deals with margin, it's just utilizing my margin more efficiently so that I can squeeze as profit as possible with the margin that I have. And I'm only in one expiration month at a time, whereas with the nested Condor, because of the amount of days that I have to get in ahead of time, I was always in 2 expirations, so I really had to put aside a lot more margin for that trade. So preferably, I'd like to be in both, but because I have limited margin for my personal stuff, I've just been doing this one. So I hope that.
And then Luke asked, how long have you been trading the Weirdor, and how have your results been? Like drawdowns, profit, number of wins, losses, that kind of thing.
I couldn't say it exactly. I'd have to go back and to give you an accurate amount, but just off the top of my head as an approximate. I've been trading this for about 1.5 years. The first half of the year, like towards the end of 2013, excuse me, I was just kind of playing around with it, trying to see what which parts of it I liked and which parts of it I was going to change and tweak or whatever, or I pretty much tried to simplify it as much for my life as opposed to doing a lot of additional things that some people do, where they add butterflies and things like that. So, so I'd say, the way I'm trading it now has been probably for this whole year of 2014. And I've pretty much found that my losses are definitely smaller than my wins. The wins have been, I want to say, an average of, anywhere from, I think the smallest, no, I shouldn't say the smallest, but I'd say an average is probably about like 4 to 5%. Sometimes it's a little bit lower and sometimes it's higher. I did have one of those sweet spot trades where it kind of got into the sweet spot on the left side, and I decided to stay in for an extra week, and it ended up working out, which was really nice. But after going through that week, of stress every day, I decided I'm not going to do that anymore, even though it worked out for me. So that kind of was an outside month, so not taking that into effect. It definitely, if I were to look at a graph of, from the beginning of the year to the end, it's definitely a lot smoother with just much smaller drawdowns because the losses are a lot smaller when they happen than the gains. And I want to say maybe 3 losses this year, as opposed to a lot of times with the vested Condor, well, the same kind of thing. You're looking at, 2 to 3 losses a year, but with the nested Condor, the max loss is about 1.5 times the amount that you're trying to bring in. Of course, a lot of times that's just a break even. But with the Weirdor, the losses are a lot smaller, and it's just, I'm not worried about a bigger drawdown with the Weirdor. And I'm, like I said, for the way I'm dealing with my margin right now, it just seems to be suiting me better right now. If I had more margin to work with, I'd add on the nested Condors as well.
And then a couple more questions. Is there a hard stop loss level? What if RUT gaps down inside your credit spreads?
I don't have. I don't have a particular hard stop level where I'm just saying take this whole thing off if it gets to something. Is that what you mean?
Yeah, I think, if you get like a massive move down in a short time, like, a gap type like a market panic, how would you handle that with trade?
Well, in a market panic, I would just, hopefully be around and watching the, that's one of the reasons why I look at the futures in the morning to see, how long I need to stick around. I'm not going to, take off if there's like a big gap down on the futures. But I would usually, in situations like that, there's really not much I've noticed that I can do in the first half hour or 15 minutes because the prices are usually kind of wacky. And usually things kind of settle out then and I can make a plan. I wouldn't say that I have like a hard plan for that. It really depends on where the position is. It depends on how many days left I have. The position can be in so many different situations of where it is at that particular point in time. I'd have to look at it as what is happening to that particular position at that time to be able to make a decision of what I'm going to do. I don't know if it really answers the question, but it's really more of,
It kind of depends, yeah.
It really depends on the position. It could be something where we have a big gap down, and because of where I am in the position, it doesn't really affect it that much. In other cases, it could, be a big gap down, and I wait the first half hour to things settle out and get, regular prices and out because it is a big, loss and there's really nothing I can do. If it's just a move down, like we have had some pretty big moves down, but they haven't been, they've been tradable, I should say. It's not like 9/11 where the market's closed and you can't do anything kind of thing. So as long as you don't have a situation like that, there's usually some kind of plan that, I'm able to put in place if I see a big drop that's going to affect the trade dramatically in the morning, and then I can kind of put a plan together as the market opens. Okay, if it continues to do this or if the prices stay like this, then I can do this. A lot of times what I'll end up doing in a situation like that, there has been a couple of, big moves down, is where I'll just end up buying additional puts just to fix my margin, so then I can kind of feel comfortable taking my time figuring out what I'm going to do. But just as a real quick margin fix, buy some weekly puts, weekly out of the money puts just to fix my margin, especially for portfolio margin. If we have a big gap down and it affects my margin, I want to kind of fix that first and then kind of figure out what I'm going to do with the position as a whole. I hope that helps.
Casey Brewer had a question. Do you look for a delta of 22 to 25 for the short options in the put credit spread as a trigger to remove or roll the spread down?
I look for, it's one of the triggers, but it's not, it depends on where I'm at in the trade. So, if it happens earlier in the trade, as opposed to later in the trade, it's going to make much more of a difference in my profit if it happens earlier in the trade than if it happens later. A lot of times if it happens later in the trade, I have a little more time to make that decision. Early in the trade, that I'm definitely going to look at that as more of a trigger. But I'm going to do my debit spreads first, and I'm going to see what's going to benefit me better, the debit spread, or by the time I think I'd have to be on my third put adjustment is when the short put on my put credit spread is going to get to about a 25 delta. So that's the time where sometimes I'll put on, it seems better to put on a debit spread, and other times it's better to just take off some of the put credit spreads. And it really depends on where I'm at in the trade at the time. And if there was some kind of whiplash, maybe I had the calls taken off before, that usually affects things too. So it's almost like, it's definitely a trigger point, but it's not a trigger point as I'm going to do it every single time. It really depends on what the graph, what the position looks like as a whole at the particular time that happens. I mean, it might be that I just take off the whole trade because it's not really going to make me any money, and I don't have a lot of time left, or I've got tons of time left. I can take it off and reposition the whole thing. It really, those types of things make a big difference in the decision of what I'm going to do, as opposed to just, triggering it to take off credit spreads. Right. But if you're not in front of your computer and you need to do something and you know that that's going to fix up the deltas and you're away, then that's definitely something that would be smart to put in as a contingent order.
Well, I think that's pretty much it for the questions, and you're getting lots of great job, kudos, that kind of stuff. So well done, Amy. Thanks for the great presentation. Oh, thanks for having me, and I hope I didn't rush too much through that last one, and I'd love to be back again and maybe show the nested condor and some more examples in more detail, as opposed to just the results that I had showed last time. Absolutely. So thanks, everyone, for coming. It's been a pleasure, and we'll see you next week, I guess, unless there's anything else. Jim, do you have anything?
Nope, just Amy, thank you so much for coming on and sharing this, and we hope that you'll join us on a regular basis or a semi-regular basis if you can. I would love to. Thanks so much, and thanks everybody for watching. We appreciate it. Okay, right. Take care.
Bye-bye.
Bye.